Greenyard NV was established in 1987 by Hein de Prey and has since grown into one of the largest suppliers of fruit and vegetables in the world. Today I'm going to discuss whether you should or should not invest in Greenyard. First of all, the stock price. The stock price is the current price that a share of stocks is trading on the market. As you can see, this fluctuates a lot during the days. This day they had 7.83 euros, and it has raised. But I prefer to talk with ratios because I can give more information then. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations. The ratio is considered bad if the outcome is less than 1. This means that the company does not have the capital on hand to pay their short-term obligation if they were all due at once. Greenyard was not able to have a current ratio above 1 in 2019 and 2020, but they peaked at 5.62 in 2021. That's good because all above the average of 2 is considered good. So they have enough assets to pay their short-term obligations. The quick ratio is an indicator of the company's short-term liquidity. It indicates whether a company can use its most liquid assets to pay its short-term costs. They were in 2019 and 2020 under the minimum of 1. As you can see, this ratio has dropped a lot in 2020. This decrease means that the company couldn't pay its short-term cost with its short-term liquidity. And the ratio also racketed in 2021, which is good. Debt ratio is a financial ratio that measures how many assets are financed by debts. If this ratio is greater than 1, it is not good for the company because this means that a lot of assets are covered by debts, and this is not good. As you can see, this was happening in 2019, but it decreased in 2020 and 2021, which is good. Solvency ratio. This is a very important ratio to measure whether a company can meet its long-term debts. It indicates whether a company's cash flow is sufficient to meet long-term liabilities. This ratio dropped in 2020, but recovered well. So it looks like Greenyard has a very stable cash flow, which is good. Return on assets is a financial ratio that measures how profitable a company is based on its total assets. Return on equity is used as a measure of how efficient a company is at generating profit, so it measures the company's ability to turn its equity investment into profits. I find both ratios too low. If I compare it to the average, there is a too big gap between the percentage. For example, for the return on assets, the average is 4% and they only get 1.8. So this is not good. They have the last year's positive numbers, so they are making a profit, but it's not high enough. If I summarize all the ratios, I find the liquidity great of Greenyard. The solvability is good but can improve, and the profitability is too low. But overall, I find that they have good ratios. The numbers on their website show us that their sales have increased and their EBITDA also increased. So this is very good because this means that they can achieve their goals even in these hard times of COVID or war. They make a better profit and can lower their debts, which is good. This shows us that their investments are making a good profit and they are growing. This article is about the last financial year of Greenyard. It shows the rising prices of the company and what kind of numbers they have. Overall, their numbers are very good, and um, it's looking great for Greenyard. Overall, I can say that most of the ratios are good in general, the stock prices are rising, and the news is very positive about Greenyard. So I would say you should definitely invest in Greenyard.